Good afternoon, class. Is there anybody that's coming for the first time? I think I've not seen your face before. First time? Okay. Any first timers? Okay, just you. Welcome. Okay. So following what we've already been doing, today we are going to dive into marginal costing versus absorption costing. So far, so good for the past, I think this is our second week, right? Third week. Okay, we've dealt on costing techniques, and I think I explained why we have to really get this part in order, because this is the foundation of the other topics which we are going to see. And for the next month, we are still going to be treating foundational topics, although a little bit more complex than what we've been seeing, before we'll now go into the real performance management tools and techniques towards September. So in the costing techniques, we've looked at different mixes. We've looked at marginal costing versus throughput. We've looked at absorption versus activity-based costing. Today we are going to look at marginal costing versus absorption costing. Now, so far, I've not been able to see a question in your part that covers marginal costing versus absorption costing. But the reason I decided to bring it, to make sure I treat it, is because you would see this absorption costing and how it applies again when we come to standard costing or variance analysis. And if you get to variance analysis, the knowledge you have already on absorption costing is not sufficient for you to understand variance analysis. And variance analysis, if you're weighing topics, variance analysis will go to the highest weight, after which you now see relevant costing and others. So for us to be able to get that topic in check, we need to get this topic in check. It's not something different from what we've already seen. This time we're just merging marginal costing and absorption, and there is a reason for that merge. And when we are merging, or we are seeing the question we'll treat today, I will show you the reason. Now, so far so good. We know that the marginal costing technique, the approach in marginal costing technique, is to treat only variable cost as product cost, which means if I adopt marginal costing in my company, then the only cost I will say I spend to produce an item are those costs that are variable. For those that are new, we have defined the various types of costs. We've classified costs using several ways, and we've defined it, and I believe it has been understood by the class. So just follow up, and hopefully you'll be able to understand. So in marginal costing, it will include only the variable cost in the product cost, which means the cost of a unit will be made up of only those costs that are variable in nature. Whereas absorption costing would include all costs that was involved in production. Obviously, even if a cost is variable selling, yes, it is variable, but in marginal costing, that does not mean it will be added to the product cost. Sorry, excuse me, I need to take this call. Hello, Madam Mata. Yes, I'm fine. Yeah, but thing now is, if you come, you don't have to wait. Oh, I'm already in this class. Yes. So I don't know. I think it will even be good you come so that you can also see Siki and talk to him together. And just have it. And just come upstairs. Yes. So because it is variable does not mean marginal costing would add it to the cost of production. I know marginal costing adds only variable cost, but this is a selling cost. It is not a production cost. The whole essence of the costing is to know the cost of producing, not the cost of selling. If you're eventually making a full income statement, that is when you will now include all of the costs, both production, both selling, both admin costs. But at this point, we just want to know the cost of producing, which for marginal, it would only include the variable cost of producing, while absorption will include both the variable cost of producing and the fixed cost of producing, but not fixed cost of selling, the fixed cost of producing. So that idea of adding the fixed cost of producing is what differentiates marginal from absorption costing. So you see that when they list all of the costs, they are all going to be production costs. If they list a selling cost, that will not be added to your cost of production, just the production cost. But in marginal costing, we'll be deducting just the variable cost of production, whereas in absorption, we'll be deducting both the variable and the fixed. Although now the way we will now treat the fixed cost is now what makes absorption costing called absorption, because for variable costs, it's fairly easy. Variable costs are costs that flow with activity level. So the more you produce, the more you spend on variable. So by the idea of variable costs, you know that you will be spending variable costs per each unit, that you can just easily add it. For instance, I use a car company coupling a car, and then they have to buy spare parts. They know how many spare parts are being put into every single car. Maybe they are outsourcing the engine and they have to buy one engine per car. So the more cars they produce, the more engines they produce. So that cost is very simple. They just have to bring in the cost of the engine and just put it directly that to produce this one car, we spent this amount of money to buy one engine. But fixed costs are not like that. Your person charging you rent, for instance, is not going to charge you rent per car. He will charge you rent for a period, not for a product. He will charge you rent for a period. So if you now want to now absorb, or you want to take this cost or this rent for a period and now add it to the cost of the items, you must do it in a way that will reflect that this cost was borne for a period, and during that period you produce not just one car but several cars, and all of them have to share that rent. Is that not so? But then when sharing the rent, you will not, at the time you are making this budget, at the time you are making this decision, you want to find out the cost of producing, you may not necessarily know how many cars you will produce in that particular year. So the information that you'll be using to say, okay, we are going to pay rent of 1 million, you would only be using an expected number of cars produced to divide the cost, not the actual number of cars. And meanwhile, the whole essence of this is for decision making, right? And decision making should be accurate. And yet we are making that decision even before we have the figures. Even as much as that, you still have to reflect any mistakes in your assumptions or any variances that you have expected to produce 1,000 cars and you actually produce 1,200 cars. That extra 200 variance should be reflected at the end in what you're doing, right? So that you present the actual cost and not a cost that is more than the actual. But at that point that you just want to calculate the cost per unit, what you have, the data you have, is your expected production, not your actual production, right? That is why at the end of doing absorption costing, we will now go further to do something else. We will check if we have over added the fixed cost because our expected was different from our actual, or whether we have under added because it was still different. That is what we refer to over or under absorption, which when you now come to variance analysis, they will now spread that over and under absorption to show you how the different things that can cause that over and under absorption. For instance, it could be that the rent that you expected is different from the rent you actually paid. Maybe something happened, your landlord increased your rent within the year. That can cause an over absorption. It could also be that the number of items you absorbed into is less than or more than the number of items you produce. It could also give rise. So when you now come to variance analysis, you will now be seeing different spreads of fixed costs. But you would understand it very easily then if you understand the process of absorbing. So when you see the process of absorbing, you can now know the variance that comes as a result of absorbing. So we're going to look at a question. The question is going to show us different costs, and we are going to produce income statement using both marginal and absorption. The question is already on your group. We see MCT versus ACT 1 and 2. Can we see it? Can we start? Have you all seen? Question was posted on the ICANN PM group. If there's anybody that's not there, you can still add the person up. Are you on the group? Okay, please add that to the group and let's move forward. While you're doing that, I'll just start to read the question. They said, from the info given below, you are required to prepare profit statement for the year ended based on 1. Marginal costing, 2. Absorption costing, and comment on the difference between the profit figures you reported in 1 and 2 above. So if the profit you got when you did marginal costing is different from the profit you got when using absorption, you should make a comment as to why the profit is different. That's the third requirement. So now let's look at the question. JB Limited produces a single product which is bottled and sold in cases. The normal annual level of operations on which the production fixed overhead absorption is based, is 36,000 cases. Data for the financial year were as follows. Production for that year was 40,000 cases. Sales for that year was 32,000 cases. Then they gave us the cost per case. The selling price is 60 naira. The cost, direct labor 12, direct material 14, variable overhead 8, fixed overhead budgeted and incurred 216,000. Selling and administration cost is fixed at 50,000. Variable selling and administration cost, under it we have the fixed selling, which is 50,000, and the variable selling, which is 15% of sales revenue. So we'll start to solve. The first one, they say we should first use marginal costing, right? So we have profit statement using MCT. This is your A requirement. Let's create 2 naira signs. I don't know if we've gotten to profit statements, full profit statements in financial reporting. I don't know how far you have gone there. But basically, a profit statement will start sales less your cost of sales. Is that not so? And then you have your gross profit. From your gross profit, you now less other costs. that is your admin expense, your finance cost, your distribution expense, before you now have profit before tax, deduct tax, and you have your profit after tax. But for the sake of marginal costing, the marginal account or managers, they call it in particular management accounts. Management accounts don't go with sales less cost of sales, because what is in that cost of sales is basically the full cost of production that of units that were both produced and sold. For managerial accounts, you have to follow the technique they've told you to use. And the technique they've told us to use is marginal costing, which means, first of all, treat the variable cost. After treating the variable cost, you cannot go further and treat the fixed cost. So we'll first start with, as usual, it will always start with sales. Sales. Now, our selling price per unit was how much? 16. 16 naira. Abi? And how many goods did we sell?
32,000 cases.
Yes, we sold 32,000 what? Cases. Please always be particular as to which units you sold and which units you produced. What you are trying to get in a profit statement as per what we call in accounting, or the concept we call, what are the two concepts? Going from performance management to financial reporting, sometimes they just go. Accrual and matching concept, right? Which states that the income for a period should be matched against the expense for that same period to get your profit, Abi? Good. So what we are checking in your profit statement is the sales, which is for that period, definitely, Abi, less the cost of goods sold within that same period. So any goods that you produce but you didn't sell cannot form part of the cost for that period. Instead, you just value it as your inventory and move it up to the next period. Is that not so? So sales is 32,000 cases at the selling price, which is what? 69. That gives us 1,920,000. Then less variable, not just cost of sales, variable cost of what? Sales. Less variable cost of sales. So in the variable cost of sales, what's the first element?
Direct material.
Direct material. Now there are two ways you can go about with this, Abi. You can just decide to take how many units were sold. 32,000, Abi. And then what you just do is you just take the cost for that 32,000. So you're just taking the cost of sales directly, Abi. That's one way you can do it. Another way you can do it, which is the recommended way, is you actually take the cost of producing 40,000, which is what was produced. But then after taking the cost of producing 40,000, you now even it out by deducting the value of your closing inventory. It's just like when you have in the profit statement, you have opening stock plus cost of purchasing or producing less closing stock. So in this question, there is no opening stock, Abi. So the cost of producing is cost of producing 40,000, Abi. Whereas the closing stock is how many? What will be our closing stock for this question? 8,000, Abi. So we are taking the cost of 8,000 from 40,000 to have what? 32,000. So as I said, you can go ahead and just take the 32,000, find the cost of producing 32. But the recommended way is take the cost of producing 40,000 and then deduct the value of your closing inventory. It should still give you the same answer, but the presentation is more accurate so that the examiner knows this is what we spent to produce, and this person or this student knows that we produced 40 but we sold only 32,000. Hence, the remaining 8,000 is deducted as closing stock. So that's the one we would follow. So we're going to have variable cost of sales. We're going to have material first, Abi. Material 40,000 at what? How much is material per unit? 14 naira, giving us
It's 14.
giving us what? 560. Which other one do we have? Labor. All these are variable costs, right? Still 40,000 at what's the cost of labor?
12.
Giving us
48,000.
480. Is there any other variable production cost? Variable overhead.
Yeah.
Okay. Variable overhead. 40,000 at how much? Yeah? 8 naira, giving us
20.
320. Is there any other variable cost in the question? But that is variable selling, right?
Okay.
So even while it's a variable cost, it is not a production cost. So it will not come here yet. So this is what we are going to do. We are going to sum it up. We cannot add the fixed overhead, even if it's a production cost. Because we are using MCT, we will not add the fixed production cost. So we'll just get the total of this. 360,000. Now to show the examiner you know what this is. This is variable cost of what? Not sales. Production. To get the variable cost of sales, we less value of closing what? Stock. And the value of closing stock, we'll just do it somewhere in our workings. Closing stock. Now we just want to compute the value of one closing stock. Still, we are using marginal costing. So the way we value our stock, we'll be adding only variable cost. So 1 unit of stock. 1 unit of stock using MCT or one case. The stock is case Abi.
Yes.
Is direct material. This is naira per unit. Direct material is how much? 16 Abi?
No, 14.
14. Then we have direct labor too. 12. And we have variable overhead, which is what? Total of what? 34. So 1 unit of stock will be valued at 34. So this will be, how many units of stock are closing? Do we have at close? 8,000 valued at 34, which we got from workings 1. Workings 1. 272. So we subtract 272,000. When we deduct this, that is now when we have the variable cost of sales. So deduct 272 from 2.
No, we're deducting from 1 million.
From 136.
1,088,000.
1,088,000. Now this is the variable cost of sales. Less from this. 832,000. 832,000. Now, sales less variable cost is called what? What do we call this when you less variable cost from sales? Contribution. Although this is not the total contribution of the firm, because we have only treated the variable production. There are other variable costs. So this will be called the production contribution, or better put, factory contribution. Is the contribution at the factory. The goods have not moved out from the factory yet. When the goods move out from the factory yet, then other variable costs will not be incurred. When you now deduct those ones, that's now when you have the total contribution. So we're going to term this factory contribution, from which we will now less other variable costs. And other variable cost is variable what? Selling, Abi,
Selling.
and admin.
Administrative.
And they said is what? 15%. 15% of sales, Abi? And what's our sales? 1920. 15% of 1920 giving us 288,000. Deduct from this, we can now have. Is there any other variable cost? No other variable cost, right?
No.
So this becomes our total contribution. 544. From the total contribution, we now less what? Fixed cost. And the fixed cost includes fixed production cost, Abi? Fixed production cost is how many? 216. And we also have fixed selling, Abi? How many is it? Total of 266. So what is our profit? 278,000. So this is our profit under MCT. Now we're going to do ACT, absorption costing. Profit statement. Using ACT. As usual, we'll still start with sales. 32,000 cases at 60, giving us 1920. Now, in this case, now it will not be the variable cost of sales. It will be the full cost of what? Sales. Full cost, both the variable and the fixed. Less full cost of sales. Material. That's calculated here. Just put it for easy reference. 14,000 at 14. 560. Labor 40,000 at 12, 480. Variable overhead 40,000 at 8, 320. Then what now makes it different is that we'll also add fixed what? Overhead. Fixed overhead, and the process of adding it is absorption. So we call it fixed production overhead absorbed. Now to get the fixed production overhead absorbed, you know how these other ones, we have the cost per unit. Material cost per unit is 14. Labor cost per unit is 12. This cost per unit is 8. But when we come to fixed production, they don't give us cost per unit. They just give us 216 what? 1,000. So we still have to get the cost per what? Unit. But what we use to get the cost per unit, what we use as our denominator when dividing, is not the 40,000 cases that were produced. It is the normal level of what? Production. What the company expected to what? Produce. And they will give it to you in the question. Good. They said the number of cases, the normal operating level upon which fixed production overhead is absorbed is 36,000 what? Cases. Did you all see that?
Yes.
That information can come in different ways. They can tell you the budgeted production is 36 what? 1,000 cases. That still means that is their expected. So they can put that information to you in several ways, but you have to know that it is their expected level of what? Production. So in our workings 2, we'll now get fixed production overhead per unit, or in some cases some people call it fixed production overhead absorption rate. They mean the same thing. FPOAR. They mean the same thing. So that just gives us, or this is just simply the budgeted fixed production overhead over the budgeted units produced. Activity level, or units. In this case, it is units what? Produced. So the budgeted fixed production overhead is 216,000 abi. They also said something when they give. They said fixed production overhead budgeted and what? Go to that information. How did they present it? Fixed production overhead budgeted and what? In the question. Budgeted and incurred. Which means they're telling you that this 216,000 was what they budgeted. It was also what they actually what? Incurred. The budgeted and the actual are the same thing. But in some cases, when we now get to variance analysis, you see situations where this 216 will not be the same as what they actually what? Incurred. And it did not just stop there. The 36,000 cases that they plan to produce is also not what they produce. So you'll be having variance because 216 is not the same as what you produce, and because 36,000 cases is not also the same, right? So that is part of what we see when we treat standard costing. So it will be 216,000 divided by 36,000 what? Cases, which is what? 216 divided by 36. 6 abi. So this is 6 naira per case. So we'll now come here, fixed production overhead absorbed 40,000 at 6 workings 2. 240 abi.
Yes.
Now this is now where the over or under absorption comes in. We've multiplied 40 times 6 as 240. Was 240 what we spent on fixed overhead? What did we incur in fixed overhead? 216. But because of the absorption process, what are we now arriving at? 240. We cannot take this 240 at face value. Even if we first put it here, we still have to even it out through what we call over or under absorption. I will give you a note of that, but let's add all of these things first. $1.6. Now the notes will now be on how to easily detect if it is over or under absorption. On face value, let me see if we know. Did we over absorb or did we under absorb? We over abi? We took more than the actual abi?
Yes.
So the actual is 216, but we took what? 240. Now let's see why this is so. What was the budgeted output? The budgeted output was 36,000 abi. What was the actual output? 40,000. Which means when your actual output is your actual output, this is your budgeted output. Budgeted also, we will just call it normal output. Which means when your actual output is more than your budgeted output, what do you have? Over what? Absorption. And to even out something that is over, what do? Do you add or deduct? The excess. You deduct. So when actual is more than budgeted, we have over absorption, which must be what? Deducted. In the reverse, when actual will not be less than budgeted, you have under what? Absorption, and you add. So just take it down somewhere. Just in case, because I know confusion may still come in later, so that just be something to guide you. When budgeted or when actual output is greater than budgeted output, the result is over absorption and you deduct. When actual output is less than budgeted output, the result is under absorption and you add. And to calculate over or under absorption, simply FPOAR times budgeted output minus actual output. You can tell me what that sign means. When you put something inside two straight lines, if this question comes out, what is the answer? They just put this 2 dashes, put -6 inside. What is the answer? So you now put approx This is called absolute value. And the absolute value of any number is that number removing the sign. So the absolute value removing the sign. So the absolute value of -6 is 6. The absolute value of 6 is still what? 6. So when I say the absolute value here, some people might just decide to put actual before budgeted. It may lead to the same number but minus. Please remove the minus and then multiply it by FPOAR. Is that not so? The minus is being taken care of by this. Deduct over absorption, add under what? Absorption. But the figure you get, whether it's minus, whether it is plus, let it just be that figure itself. That's it. So can we now, in this case, we've already figured out that budgeted output or actual output is more than the budgeted. So there's over absorption, Abi. So at this point, we are going to less over what? Absorption. And less over absorption, this is the formula. The over absorption itself is the FPOAR, which we've calculated at what? 6 naira per case. Excuse me. Matter? Oh, you come to the other side though. Just hold on. I'll come downstairs and direct you. I don't know if you know the theft. No, it's in front. Okay, come to the roundabout. Just come down. Come downstairs. Come down to the roundabout. When you get to the roundabout, come. So this is 6 times. They said budgeted minus actual. What's budgeted in this case? Budgeted in this case is 36,000, Abi. Actual is what? That should give you about 4,000, Abi. Yes. 4,000 times 6. 24,000 abi. So normally because of this minus sign, it's supposed to be minus 24,000, but this is the absolute value. So we just take 24,000, and because it is over absorption, we deduct. Is it 24 or 240? It's 24, abi? 24. And also to still confirm it, what we actually spent is 216. What we absorbed is 240. The difference between the both sides is still 24. So anyway you want to go about it. Now deduct from this, what we have? 1.6 minus 24,000.
576,000.
At this point, this is full cost of what? Production. From full cost of production, because we're looking at cost of sales, we will less value of closing stock or closing inventory. And now this is how we valued closing stock using MCT. I also value using ACT. Using ACT, we'll still have direct material B, we'll still have direct labor, we'll have variable overhead, and then we'll have one more. Fixed what? Overhead absorbed, which is the FPOAR. Let's put it here, 34. And test POAR is what? 6 abi. So add everything, what we have? 14 plus 12 plus 8 plus 6. 40. So under absorption costing, each value of stock will be 40. And we have 8,000 units of stock at 40. So 8,000 by 40. 320,000. Deduct from this, we'll have our full cost of sales. Deduct from this, from the sales, from 1920. 664,000. Now in this case, we had our factory contribution. But when you deduct sales, when you deduct full cost of sales from sales, what do we normally have? To not be contribution, cannot be contribution. What we have? In this case, now when we deduct, we call it contribution. Here, what we call it? Sales less cost of sales. Less the full cost. Gross profit. Good. So this is gross profit. From the gross profit, we will now less other costs. And the other cost here is selling and admin, abi?
Yes.
Selling and admin. And it has both variable and fixed. The fixed part being 50,000, abi? And the variable part being 15% of the sales, which we've already calculated as what? 288. 288. 288,000. Okay, so 50 plus 288.
The place is hot. Open the window, there's no fan, please.
So 50 plus 288. 50 plus 288. 338. This is working 1. 338,000. Deduct from this, what do we have as our profit? 326,000. Now, going to the last part. Okay, 1 minute. Remember matter? Yeah, are you at the roundabout? Which one about where you going? Okay, listen for go like this. Yes. Now, for us to finish this part. No, I'm not really working. This part is okay. Now, the C part of the question, this is B. The C part of the question was this. Can somebody read the C part? Comment on the difference between profit in both, Abi. Now, let's look at profit. Which profit is higher? The profit under ACT, Abi? Profit under ACT was 326,000. Profit under MCT was how much? So what is the difference first? 326 minus 278. 278. Okay. 48,000. Now, commenting on the difference is saying why are they different? What in the two calculations caused this difference? Let me see if you are paying attention. What in the both profit statement caused this difference? Is it the sales? The sales here is the same thing, Abi? Is it the material?
No.
Is it the labor? Variable overhead? Is it fixed overhead?
Yes.
How is it fixed overhead? Fixed overhead here that we treated here, the fixed overhead, where is it? Is 216, Abi?
Yes.
The one here is 240 minus 24, which is still 216. So it's still the same. Is it the closing stock?
I think the absorption different.
Is closing stock. Closing stock here is 272. Closing stock here is what? Are they the same? No. Yes, this one treats fixed costs differently by first of all absorbing before evening it out using over and under absorption. But at the end of the day, the fixed costs in both of them are the same. The only thing with a standing difference is that this one value their closing stock at 272 because they use only variable costs. Whereas this one value their closing stock at 20 because they use both variable and what? Fixed. So now let's see if that's because of the difference. What's the fixed cost under ACT? Sorry, the closing stock under ACT. Yes. 320 Abi. And what's the closing stock under the other one? Can somebody deduct?
40,000.
320 minus 272. Is it not the same thing? So in your comments, you will be putting that the cost of the difference between profit under MCT and profit under ACT is because of the valuation of closing what? Stock. The 48,000 difference from the both of them is the same difference as to the closing stock of MCT and the closing stock of what? ACT. That is all for MCT versus ACT. You can write when I come. Just give me 1 minute. Let me see somebody outside. Come, we'll look at another costing technique. Yes. Yes, I'm asking. Give me an instance.
If you start a business today, maybe you need to start first. So you do this. But if I've invested like 1 million, I should put the target like close to 100,000 as profit.
As profit, Abi. So basically, what you are targeting is how the value of your investment would increase, Abi, in terms of profit. So this 100,000 is an extra to the 1 million. Now, in investment, we call that 100,000, we call that target, we call that return on investment. Right? So whenever you meet an investor, what they want to hear is what's the ROI of this investment? Is it 10%? Is it 5%? Is it 6%? If the ROI is better than what they will get from investing their money in the bank, then they now consider the investment as plausible. Right? Good. So that's return on investment. Now, what target costing does is that target costing is going to show what the estimate of cost is going to be if you intend to meet your target. Right? So while the other costing methods, you start from the cost before you now deduct the cost from the selling price, and then from the selling price you now get your profit, and then to the ROI. When you use target costing, you start from the profit you want and then scale back to the cost. So in this case now, we want 100,000 from 1 million, Abi. That means our profit should be 100,000. So we'll now look at profit is 100,000. Then maybe we'll now check it's a product that is competitive in the market. So we are most likely not going to be the ones to even decide what the selling price is going to be. Yes?
So you said target cost
Shows. Okay, you want to write? Okay, basically, other costing techniques start from the cost before they come down to the profit. They start to estimate the cost, drill down to the profit. When you use target costing, you don't start from the cost. You start from the profit that you want and then now scale up to the cost that you will have to incur so that you can actually have that cost. That profit. Or the selling price you have to sell the product so that you'll be able to make this profit. So depending on what you can control, what you cannot control. Assuming you cannot control the selling price, right? That means selling price is fixed by the market. Then you will now be looking at how many products do I have to sell to be able to meet up this profit of what? 100,000. But the bottom line is that you first of all know what your target is before you now know what you want to sell the product at or the cost you have to incur for it to make that target. That is target costing. It is a very useful tool when you're budgeting. So if you just know or you have in mind, I want to make this particular amount of money. Maybe Mr. Siki said, at the end of this diet, I want to make 1 million. Good. Then he now checks what is the average price a teacher is going to collect competitively. He checks maybe it's 150, maybe it's 200, maybe it's 300 per course. And then he multiplies it by the number of courses. And that shows him he will spend a total of 2.5 million to deliver this course. And he wants 1 million, Abi. That means he must make a total of 2.5 plus 1 million, Abi, which is 3.5. He now checks, okay, competitively, students can pay 500,000 for this class. And then now says, okay, students are paying 500,000 for this class. I just need 7 students. So that's how target costing operates. When you decide what your profit level is, then you now use that profit level to be able to estimate the other things that will help you to make that profit. So now we're going to look at a question that will give us different scenarios. The question is going to tell us to price a product. This target costing, you will also see it when we come to pricing. Something similar. I just did not see a question on solely target cost. So I decided to use the pricing question because it still deals on it. So we're going to look at a question and we're going to find out the price that we'll get to be able to meet up the target ROI. So now let's look at, I think, have I posted the question?
Yes.
In this case, this question does not really treat solely target costing. It treats target return, but by solving it, we should be able to understand how it works at the end. So this is question 7 of, let me check the year. This question 7 of May 2019. May 2019, 15 marks. Question 7, May 2019, question 7, 15 marks. So let's now read up. Said, Pack Nigeria Limited produces various types of packaging products for the industry, for the food industry. TNL has just introduced a new type of pack, and its marketing manager is considering how to penetrate the market with the pack. The following pricing strategies. So this question cuts across both targeting and pricing. The following pricing strategies have been suggested. Pricing is also part of your scheme. We'll treat it eventually in full. So the first pricing strategy is market skimming. The second one is market penetration price. The third one is full cost plus price. Fourth one is return on investment price, which is the main one I want to look at. And the fifth one is marginal cost plus price. The management accountant has provided the following data about the pack. Non-current assets needed for production of the pack is 2 million. Working capital requirement is 400,000. Estimated annual sales volume is 40,000 units. The variable production cost is 16 naira per unit. Fixed production cost is 300,000 each year, and annual non-production cost will be 100,000. The markup for the pack is as follows. If full cost plus price is used, 25% markup. If marginal cost plus price, 40%. If target return on investment is used, 10% per year. Discuss the above pricing methods and advise when each could be used. That's first one. Then calculate the price of the pack if it is based on full cost plus, marginal cost plus, return on investment pricing. So I'll just explain all of the pricing techniques. As I said, we still revisit it when we treat pricing in full. So the first one is market skimming. Market skimming. Now, to just explain it, market skimming is the opposite of market penetration. I know you know what penetration is. So let's start with penetration. If you want to price a product using market penetration, what are you trying to do? Do we know an example of, okay, let me know if you know what it is. You want to penetrate the market. What does it entail? How will you go about that? How will you use your price to penetrate the market? You use low price, Abi, to entice people. An example of a product that has done this. A product that entered the market through low price, got everybody, and then they're adjusting their price. Yes? Right.
It used to be very cheap. Yes.
Hypo. Many other types of bleach, right? I thought hypo has been the only bleach.
Very low price. Yes.
Bleach itself. So hypo came in and with low price and now hypo is expensive now. I think that same thing Viva, but no, Viva did not do market penetration like that. Viva did quality. They did hybrid. They were affordable. They were also, the packaging was also very nice. So basically, market penetration, people that have this approach very well is the Chinese. The Chinese enter the market and destroy other products with price. They give you ridiculous low prices, good quality, and then over time when they have the market, they start to adjust the prices. So that's basically market penetration. Those ones, they just created it for people that you cannot penetrate people out of iPhone now. You cannot penetrate them. They're not buying it. So some certain products, those strategies do not work. So most likely, that's why they now said, give instances where each one will work. Market penetration will work in a market where the products are undifferentiated. If the people don't really pay attention to the quality of each product for them to buy, like the jig, how do you know the quality of the jig? Is it that you're white when you soak it in this thing to be more whiter when you use? You understand? So it's very easy for somebody to just enter the market and just give you something cheaper and you just switch, right? So when a product is largely undifferentiated or similar across different product types, then market penetration is a wonderful technique. Another one is if the switching cost is low. It costs you nothing to switch from jig to switch to another different thing. But if you want to switch, say, the current insurance company that is following or you're following, you have to go through a ridiculous number of this thing that when you just think about it, there's some certain things, products that somebody just come. If the stress of just leaving the one you're already using is too much, sometimes it's even your SIM card. A new SIM just comes and say, oh, data here is very cheap, it's 5 naira you can. But how do you want to start telling everybody you've changed contacts? You understand? So if the switching costs are very low, then it's easy for you to switch. But if the switching cost will cost you a lot, then it's difficult to switch. Market penetration will not be wise for a company to come in and use, right? So that's another way. Market scheming is the opposite. Market scheming is when you start from a high price and then now go low. What could be the justification for doing that? You enter as a high price product and then you start going low. What could be the justification? Yes. So competition made you set your price high.
No, the cost of producing the item.
That could be a way. That could be a way. It could be that you initially wanted to set your product as a luxury product, right? To get people to just view it in that manner. Then eventually, when they now view it in that manner, you now give them offerings that are lower, that they feel like, okay, we can actually afford this. Like Chicken Republic. Yeah, I think Chicken Republic has fairly been affordable since. But there are certain places that have been so expensive, so much that the only reason you already waved them off. You wanted to buy, but you know that they're too expensive. Then the moment they just say if price is cheap, you just rush and go and buy it. So basically, some companies decide to follow that strategy. They set themselves as high price so that you view them as a premium product. Then eventually, they now wheel you in by now reducing their price. That is market scheming. Then the other one is full cost plus price. Full cost plus price. This is a company now that is fully aware of their costs, right? And my advice is, using cost as a pricing strategy is a very, very bad pricing strategy because you're considering internal data rather than external data. Your customers do not owe you. They don't know what is happening in your company. They don't care. They just know the difference between product A and product B. So if you're spending too much, it's none of their business. And Nigerians are very used to this. You just enter a new market. You don't do any market survey. You don't find out what other people are charging for the same product. You just say, I'm spending too much to deliver this product, hence I'm selling it at this price. Well, your people that are buying from you don't really care. So this strategy is just used for a company that just wants to play safe. But generally speaking, from a marketing perspective, it's very, very terrible strategy. If you look at some of those big companies, they started Amazon and the rest. They were not thinking about how much they were spending. They were just like, customers want to buy it at this price, therefore we will deliver at this price. If we cannot deliver, then we'll cease trying to sell. But if we can deliver, then we now have a profitable product. So markets full cost plus price is just where you calculate the full cost of production. That's both your variable and your fixed cost. And then you now add something on top, something we call markup. And the first thing we look at concept of markup and margin. This is another thing that would also be seen very well throughout our PM journey. So when you get your full cost, you just add the percentage on top of it. Then return on investment. Return on investment, as I've said, is still now target. It's now target pricing. In this case now, you know the return on investment you want to make. They've given you your cost in this question, right? Good. So you know that your profit or your return is your selling price less your cost. Your sales less your cost. So if you know your cost, you know what you want to be your profit. Then you can use that to now estimate what selling price you will sell so that you'll be able to meet up with that cost and meet up with the profit. Then the last one is marginal cost plus. It's still like full cost plus, just that you will add the percentage to your marginal cost and not your full cost. So now let's now look at it in the context of this question. They said calculate what the price of the pack should be if the price is based on, because they cannot tell you using market scheme now, because that would just mean use an abstract price in your head for market penetration. So the first one is full cost plus what? Pricing. But before that, let me go into markup and margin. Now, we have cost of a product, we have selling price, abi? Sales. And we know that sales minus cost is equal to what? Profit. Which invariably means cost plus profit is equal to what? Sales. Now, markup goes with cost. Margin goes with what? Sales. It is simply expressing profit as a percentage of, if you're expressing it as a percentage of cost, it is what? Markup. If you're expressing it as a percentage of sales, it is what? Margin. Please always watch. You can easily convert markup to margin, but you cannot apply margin on cost, and neither can you apply markup on what? Sales. So if a question has given you your cost figure and given you margin, the first thing you ought to do is to convert that margin to what? Markup, before you now apply the percentage on cost. If a question has given you sales and markup, you first need to convert the markup to margin before applying it on what? Sales. Again, let's write that. Markup is an expression of profit. Markup is an expression of profit. Markup is an expression of profit as a percentage of cost. Is an expression of profit as a percentage of cost. In other words, markup is equal to profit over cost times 100%. Markup is equal to profit over cost times 100%. Margin is an expression of profit as a percentage of sales. As a percentage of sales. In other words, margin is equal to profit over sales times 100%. to convert convert it's not in every case they will express it in percentage. Percentage is optional. They can express it as a fraction. They can tell you markup is 1/3. That's not a percentage. If you want to convert it to percentage, it should be 33%. I'll tell you 1/4. They can tell you margin is 1/5. Now let's now look at a scenario where they are not using percentage. They are trying to convert. Let us say the selling price is 100. The profit on each item is 20. What will be the cost? If selling price is 100, profit is 20, what will be the cost? 80, right? So by all means, markup here is going to be profit over cost price, 20/80, which is 1/4. Margin is going to be what? 20 over what? 100, which is 1/5. Now, if you want to convert 1/4, that's the markup, to 1/5, what do? You add 1 here, Abi. This will give you 1/what? If you want to convert this to 1/4, it will be 1/5 minus what? Which is 1/4. So this is the basic thing here. If you want to convert, first of all, convert in fraction. If they give it to you as a percentage, convert that. Excuse me. Alamat, I've not been able to reach you. I was calling you. The school final. Okay. So the first thing is convert in fraction, don't convert in percentage. If they're giving you 20%, you convert that 20% to fraction 1/5. Particular fraction, not decimal. Let it have a numerator and let it have a what? Denominator. So the assumption is that the numerator is profit in the case of markup, and the denominator is cost price in the case of the same markup. In the case of margin, numerator is profit, denominator is what? Selling what? Price, Abi. Now we know if we want to convert this markup to margin, we just have to change this cost price to what? Selling price. And to change cost price to selling price, you simply add what? Profit. Abi? That is why we took this one here and added it to the cost price of 4 to give you 1/5. In this case, to change selling price is simply to deduct profit from selling what? Price. So to deduct profit from selling price, simply take this profit here that is 1 and deduct it from 5, and that gives you 5 minus 1, which is 1/4. So it's very simple. To convert from markup to margin, simply add the numerator to the denominator. Remember, okay, let me take this down. To convert, you must first of all ensure it is a fraction. Ensure it is a fraction. Ensure it is expressed as a fraction. It is expressed as a fraction and not a decimal. And not a decimal or percentage. First of all, ensure it is expressed as a fraction and not a decimal or percentage. And not a decimal or percentage. That is must have numerator and denominator. That is must have numerator and denominator. Must have numerator and denominator. Must have numerator and denominator. To convert markup to margin, To convert markup to margin, simply deduct markup to margin. Is it deduct? Okay, add. Simply add. Yeah, have fun. Have fun. In class, I'll call you back. Simply add the numerator to the denominator. To convert from markup to margin, simply add the numerator to the denominator. Simply add the numerator to the denominator. To convert from margin to markup, to convert from margin to markup, from margin to markup, simply deduct. From margin to markup, simply deduct the numerator from the denominator. Simply deduct the numerator to the denominator.
From.
So yeah, from the denominator, yes. Simply deduct the numerator from the denominator.
Hey, hold on, please. Hold on, please.
Okay. Good day, sir. Easier? Okay, the next.
Please hold on. Hold
Okay,
on.
this time. Okay, I'm coming.
Good afternoon, sir.
Should you just give us like 5 minutes?
No problem.
Okay, so let's quickly solve this. So now let's look at, they said full cost plus pricing, Abi. A. Full cost plus pricing. Because it's cost, the pricing here is full cost plus markup, Abi. Now let's say, what are the things that make up the full cost? Do we have material? Let's look at the question. What are the things that make up? I think they just give us variable costs from the question. It says non-current assets 2 million, working capital 400,000, sales volume 40,000. Variable production cost is 60 naira per unit, Abi. That's the first one. Variable production cost 60 naira. Is there any other cost? Fixed production cost will be 300,000 each year, and annual non-production cost will be 100 what? Thousand, Abi. So fixed production cost, we are adding it now because it's full cost, Abi. Full cost, so we would have fixed production, but we cannot add the total to the units, so we have to convert the total to units. What's the total here? 300,000, Abi. How many units do we have? How many units were produced? 40,000 units, Abi. So divide. $7.5. Then they said